Hey everyone, welcome back to Corporate Decoder. Today we are diving into Ares Industrial Real Estate Income Trust, and trust me, this is going to be more exciting than watching paint dry, but maybe not by much. Just kidding, well kinda. We're unpacking their latest report, and there are some juicy numbers that tell a real story about where this real estate giant is heading. Before we deep dive into these corporate secret documents, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we share our live takes. Come join. The company filed a report for May of last year. Essentially, this report gives us a snapshot of how the company was performing leading up to that point. Think of it as a report card on their financial health, including how much everything they own is worth. Let's scroll down to the good stuff and talk numbers, starting with where the bulk of their money is, properties. As of May of last year, Ares Industrial Real Estate Income Trust had about $9 billion invested in industrial properties. That's a huge number, showing where their primary focus is, investing in warehouses and similar real estate. Now, let's see if the value of those investments has been going up or down in recent times in a time frame where investors are concerned about real estate. Next up, investments in these joint venture partnerships are in the tune of about $20.7 million. These are smaller investments compared to their direct property holdings, almost negligible, but show that they're partnering with other companies now and then to expand their reach. They have a good chunk, around $448 million, tied up in debt and securities related to real estate. This part of their investments can often provide the most reliable income because they earn interest on the loans they've made. The company is holding about $35 million in cash. This is important because a good cash amount available to a company means they can easily cover short-term expenses or jump on new investment opportunities when things in the market go jittery. Although it shows as part of the calculation to their net asset value, the fact that this value declined strongly, almost a 50% decline, indicates some activity such as the acquisition of new real estate assets that might generate a negative cash flow on the short run. Now let's check the company's debt. They owe almost $4.3 billion, which comes from lines of credit, term loans and mortgage notes. Debt is something you always want to keep an eye on because too much debt can be a problem if the company can't keep up with its payments, but a little well-managed debt makes sense for this business as it can help them grow faster than using only their own money. They also have about $96 million in secured financing linked to real estate securities investments. This means they've borrowed money using these investments as collateral to do even more projects or investments, and it represents additional risk. They have about $611 million in financial obligations linked to their DST program. Now, this program is a way for investors to buy into real estate indirectly. The DST is a trust where several investors put money to acquire beneficial interests in properties, and the amount indicates debt payments associated with it. The total net asset value, or NAV, for all fund interest is about $4.66 billion. The net asset value is basically what the company is worth if you subtract all its debts from all its assets. This value is the true value of what's left to investors. The total fund interest outstanding are approximately $359,820. This number tells us how the company's ownership in the fund, such as stocks or what they call OPAIR units, are split amongst all the shareholders and partners. The net asset value per fund interest is approximately $12.95. This is an important number because it tells investors what each share or unit is theoretically worth. It is calculated by taking the total net asset value and dividing it by the number of outstanding fund interests. One of the key assumptions is what is called the exit capitalization rate of about 5.7%. This rate is like a measure of expected return when they eventually sell these properties. The discount rate, which in this case is also the internal rate of return, is estimated to be around 7.3%. That is what you should expect as a baseline minimum for this type of investment. This rate is used to determine the present value of future cash flows, so it's crucial in deciding whether an investment is worth it. They estimate holding on to properties for an average of about 10 years. This long-term view affects how they plan their investments and manage their properties, aligning with a strategy of steady long-term gains rather than quick flips. As of May of last year, they own 258 industrial buildings, making up about 55.3 million square feet of space spread across 30 markets. That is a big portfolio showing just how extensive their operations are. The interesting point is that those properties are at 94.6% capacity, which is really good news. It means that almost all of its properties are being used, providing those rent payments and cash stability, although you should keep in mind that this report is almost a year old. Their leverage ratio, which is debt compared to assets, was about 45.4%. This number gives you an idea of how much they are using debt to finance their operations. It's an indicator of both risks, since higher debt means higher risk and potential reward, as using debt wisely can juice profits. The sum of common stock and OP unit redemptions requested for April and May totaled to about $69 million. This indicates what investors want to cash out and how quick they want to exit the business and take their winnings from the table or leave a sinking ship. This happens when people are losing trust in the company, but that should be compared over time with how the company has performed. There are some very successful companies that investors might be scared of. So what's the big picture here? Ares Industrial Real Estate Income Trust has a diverse investment strategy focusing most heavily on industrial properties, but also spreading out into real estate debt and partnerships. Their asset allocation looks promising, and with a good occupation rate of almost 95%, they seem to be doing quite well. However, the report doesn't tell us anything about how and if they are planning to grow. With market conditions like the ones we have now, the company should provide a clear future plan. Based on the numbers, their long-term outlook and how they manage debt should be a focus in the coming years. Alright, that's our breakdown of Ares Industrial Real Estate Income Trust's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.